Hi guys, welcome back to my channel. Kelvin here. So, as you all know by now, US inflation has been going to the moon. And in order to fight inflation, the Fed has been raising interest rates over the past few months. Then Fed be like, but wait, that's not all. Because they are also doing something else. And that is quantitative tightening or QT. Yes, the same QT that Chicken Genius is warning us about through his vague messages on Twitter and short videos on YouTube, which often comes with a pretty girl, of course. So in this video, I want to explain what is QT and why is it causing so many investors to paper hands and sell off their holdings. And more importantly, will QT crash the market? But as usual, before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute cow. Alright, let's start right now. So, to understand what is QT, you need to first understand the opposite of QT, and that is quantitative easing or QE. Now, when most people talk about QE, they imagine Papa Power printing out tons and tons of cold hard cash. That's actually not what's happening. Instead, QE is a bit different. Let me explain using this fantastic video done by Wall Street Journal. So, this is the Federal Reserve or the Fed. To do QE, the Fed will first buy treasury bonds and mortgage-backed securities from the open market. This effectively reduces the number of securities in circulation. When supply goes down, demand will go up. And when demand goes up, the price of the securities will go up too, which causes the yield to go down. Now, because treasuries are often used as a benchmark for other types of lending, when treasury yields go down, corporate bonds and mortgages will become cheaper too. This makes money cheaper to borrow, which in theory will boost hiring and spending, and that will help the economy to do well. So that's QE. QT, on the other hand, is the exact opposite of QE. Instead of adding more securities to the balance sheet, the Fed will reduce the number of securities in their balance sheet. There are two ways to do this. They can either paper hands and sell the securities, or for this round, they plan to do nothing and just let the securities mature by themselves. When the securities mature, the borrowers return the money back to the Fed and the Fed's balance sheet will shrink. Because the Fed is not buying securities off the market, the supply is higher, demand is lower, leading to higher yields, which means now the money becomes more expensive to borrow. So that's QE and QT. In summary, you can think of QE as putting more money into the economy, which will make everyone spend more, and QT as taking money out of the economy, which should make everyone spend less, and eventually cool down inflation. So what's the plan? Starting from June till August this year, the Fed is planning to shrink their balance sheet by $47.5 billion every month. Then, from September onwards, they will be increasing the amount to $95 billion every month. If this continues on, they will shrink the balance sheet by $1.5 trillion by the end of 2023. As for when it will end, no one knows for sure yet. Analysts from TD believe that QT will continue all the way till late 2024, while Vanguard believes that it can continue till 2025 when the Fed reaches an optimal size for the balance sheet. Quick pause. Webull is the latest stockbroker in Singapore. With Webull's $0 commission-free trading, you can now buy your US stocks, US options, and Hong Kong stocks for a low fee of $0. Webull also supports fractional shares, so you can now buy your stocks with just your $100 Ang Pao money. If you sign up now, deposit at least $1,965, then make 6 buy trades on either US stocks, ETFs, or options, you will get $100 worth of free Google shares and $8.88 worth of free Meta shares. This promotion ends on 1st September. So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. So here's the important question. What's the effect of QT on the market? To answer that, we have to first look at what happens when there's QE. As mentioned earlier, the Fed first started QE in 2008. Since then, there were a total of 4 QEs, bringing the Fed's balance sheet from $800 billion all the way to just under $9 trillion this year. And the effect? Check out this chart. This is M2 money, or the money supply, like cash, checking deposits, and easily convertible near money that's flowing around in the economy. See this big jump? This is when the Fed started doing unlimited QE when the pandemic started. And we all know what happened that year. The market immediately did a V-shaped recovery and went up by 100%. Meme stocks like AMC and GameStop started going all the way to the moon. Investing at the time was super easy. All you had to do was just close your eyes, throw your money into any random stock, and chances are you will make a ton of money. Everyone was an investing genius at that time. And of course, this also happened in all the previous QE. Since the first QE till last year, the market went up by almost 300%, making it the best performing bull market since World War II. So that's QE. What about QT then? Will it crash the stock market? I don't know. Actually, not just me who doesn't know. Even the Fed themselves have said that they don't know, as there will be uncertain effects from QT. QT has only been done once in 2018. So let's check out what happened during that time. This is a chart of the S&P 500, and below is the Fed's balance sheet. When QT was first announced in September 2017, the market was doing super well, partly because there was a reduction in tax rates during that time. Then, all of a sudden in February 2018, the market suddenly dropped because there were fears that inflation would go up. After that, throughout the whole of 2018, the market basically went nowhere. And just when the market hit an all-time high, it crashed by 20% within just 2 months, going back to 2017 levels. The Fed then had no choice but to end their QT program earlier than expected. So that's what happened in the last QT. Here's another chart showing the effect of QE and QT on the market. During QE periods, the market was giving positive returns, and during the last QT period, the market gave negative returns. So it seems like QE is good for the market, while QT, not that good. The plan is to reduce the balance sheet by around $3 trillion, basically 4 to 5x the original amount within 2 to 3 years. And that is huge. According to a study done by Oxford Economics, they estimated that in 2018, a $660 billion QT resulted in 18% correction in the stock market. And so far, the market has already dropped by 18%, meaning it has only priced in a third of what's going to happen in 2023. So, sell ah! Wait. Before you hit the sell button, let me explain what can actually happen to the stock market. While it's true that in all the previous QE, the market has given positive returns. But the truth is, it's not just because of QE alone. There were other factors which boosted the market. Labor productivity went up during that time as companies were producing more goods and services. There was a tech boom as companies like Apple, Microsoft, Amazon, Google quickly grew during that period and became the top companies that we all know now. Interest rates were at record low levels. Donald Trump introduced aggressive tax cuts and increased government spending. All this led to the positive returns that we saw during QE periods. Same for QT. While the market dropped by 20% during QT period, there were a lot of other factors which contributed to it. US and China were busy giving each other tariffs in their trade war. The Fed was raising interest rates during that time. The top tech companies, which makes up around 10% of the S&P 500, were under a lot of scrutiny, which caused tech companies to sell off. And prior to that, S&P 500 had already went up by a lot. By the end of 2018, it had a 33 Shiller price to earnings ratio, which is quite overvalued already, and was due for a correction. In short, it's not just QE market up, QT market down. There were a lot more things going on. But with that being said, all of us can agree that QT is bad for the market to some degree. Add that along to the fact that the inflation is still super high. Interest rates are still going up, a recession could still happen. Supply chain issues are still ongoing. The pandemic is still not over yet. A war is still going on. The China property crisis may get worse and even spread globally. Energy prices may go back up. When you add all this up, we can safely say that the chances of the market going down is a lot higher than the chances of the market going up. But of course, this is the market that we are talking about, and the market is super unpredictable. If we look back at the previous QT, the market actually bottomed at the end of 2018, 3 months before the Fed announced that they would slow down QT. By the time QT ended, the market had already gone back to all-time highs. Besides that, the economy is arguably in a better position than we did QT back in 2018. Job data looks good, GDP data looks good, and if anything, the Fed can still stop QT anytime they want. So here's my take. Currently, I'm still a little bearish, and if I were to pretend that I know how to draw lines on a chart, I might even convince myself that the market is still in a descending channel. But you know, this is the stock market that we are talking about. It doesn't care what we think. So here's how I'm investing now. But I think you already know what I'm going to say. I will continue dollar cost averaging in as usual. Market up, I buy. Market down, I cry a bit, then I buy more. I will also be keeping war chest money at the sidelines, ready to deploy if ever a crash comes. If I can keep doing this over the long term, I'm quite sure that I will do well, because stocks. Anyway, that's all for this video. Hopefully it helps you out. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.